Johnny Roberts, welcome back to another exciting, action-packed episode of your podcast.
It's good to be here, Mike. How are you today?
I'm really, really well. Super excited. I've been listening to this little mini series we're doing here, these 4 episodes with retirement tax expert Heather Schreiber. And while last time she just blew my mind with this tax torpedo and all the hidden things that are going on. And I was like, whoa, didn't even see that one coming. And I know this time you guys are going to dive into some more cool things around Roths and something about convertibles, or I don't know, but I'm just going to be quiet and let you run with it because you guys are way smarter than me.
No, this is like the thing no one ever wants to talk about, but it's one of the biggest pieces of folks' retirement. And it's kind of like that silent thing that's behind the scenes that clients come in, they sit down with, here, Johnny, here's all the stuff we got going on. And like I said, it's that boom, the thing we talk about, point out to them that they're like, wow, I didn't know all this, these details. And so this is one of the biggest things we try to provide hope, solutions for. One of the biggest concerns people when they come to our seminars and our classes, like they're concerned about taxes. And this ties in along with all that because most people have these IRAs these days, traditional IRAs, and then we're hearing about Roth IRAs. So we've been kind of going along those lines, tax complications, tax situations, traditional IRAs. We've got Heather Schreiber with us, phenomenal tax expert that we're able to unfortunately partner with that helps our clients in a phenomenal way, as well as people across the country. I mean, she teaches at classes and seminars all over the place. It was a blessing to be able to snag her down for these last few episodes and for next week as well to help us out. So, Heather, we are now transitioning into what we call like the Roth IRA world. We're going to talk about kind of like what are the rules of the Roth? What are they? We know traditional a little bit. We discussed that. Tell us like these rules of the Roth IRA. What are these guidelines so people know that you run into the most that you're saying, hey, these are the questions I get all the time?
Yeah.
Because I know the ones I get, but what do you get as well?
Yeah. So, I think we've gone back and forth enough between the first two episodes about the difference between traditional and Roth. Um, Lifetime RMDs for the traditional, no RMDs, lifetime RMDs for Roth. That's a big one. Tax-free for qualifying distributions in Roth. We'll talk about qualifying distributions. Taxable on traditional. And so with Roth, there's a lot of confusion about what it means to get to that golden egg, to get to tax-free. Now we know that the contributions or conversions, and I think we're going to talk a little bit about when conversions make sense in the next segment, but when the earnings, so right, we put money into a Roth, either we convert money and we pay taxes as we convert it, or we contribute to it. We're not getting an upfront tax deduction on a contribution, but all of that money then grows tax deferred. So it's sitting in that Roth IRA growing tax deferred. What does it take to be tax free? And that's what we're really that's the golden egg. We're trying to get to that so that we have predictability in retirement. We don't have to worry about what the tax rules are at the time we withdraw it. And there's two critical ingredients to qualifying distributions. And this is the common question I get. You have to have two things met in order to get to your gain or your earnings tax-free. And they are these. You have to hold that Roth IRA for 5 years. There is only one 5-year clock. And when does that 5-year clock start? It starts with January 1st of the first year for which you made a contribution to a Roth IRA or a conversion. Okay, so let's say that the very first time I've ever made a Roth contribution was in 2024, and I don't make it until April 15th of 2025, knowing I can do that. I can make a prior year Roth contribution up to my tax filing deadline. My 5-year clock, because it's the first Roth I've ever owned, will have started January 1st of 2024. So I get kind of a freebie. I get 15 months of freebie on that 5 years, right? Now, that is the only 5-year clock I'll ever have. So fast forward 15 years from now, this Roth IRA that I just started may be long gone because I've transferred it to another Roth IRA somewhere else. But once I get past what that 5-year, 4, 5, 6, 7, 8, by 2029, January 1st of 2029, I've met my 5-year clock. Okay. I've met that. I never have to worry about it again. But I also have to have a qualifying event, right? So it's a dual-pronged thing to get to tax-free for having my Roth be completely tax-free. And usually the qualifying event is turning 59 and a half, right? We know 59 and a half is a critical age, right? It's when we are no longer subject to 10% penalty on early withdrawals from most types of plans. But it's also the most common qualifying event for getting to a Roth tax-free. So you got to have your 5 years met and you have to be 59 and a half. Now there's 3 others. One is death. So if I'm a beneficiary of someone, then I'm not going to pay, no matter what my age is, I'm not going to pay taxes on that Roth distribution to me as long as it's been held for 5 years. Okay. Disability, if I become disabled as a Roth IRA owner and I've had it for 5 years, that also grants me a tax-free Roth distribution. And then there's this first-time home purchase, which is a maximum lifetime limit of $10,000. Essentially, what you need to really get to, and what we're all trying to get to, is 59 and a half, right? That's the most common. So the point is, contribute to your Roth IRA early on. I have a much younger sister and I'm like, Roth it. I'm like, you're
Right.
welcome. When I'm long gone, she's 24 years younger than me. I'm like, you'll be thanking me as you put flowers on my grave, because you will be wealthy and you won't have to worry about Uncle Sam if you start putting your money in a Roth IRA now and you let that thing ride. And you're going to have your 5 years long gone. She's been doing it for 3 years already. She's got 2 more years to get her 5 years under her belt. Now she's young, so she's got to wait until 59 and a half. But all that tax deferred growth, once she hits 59 and a half, all of it comes out tax free. So that's the biggest question I get about Roth IRA. When is it tax free? Is that so 5 years, 59 and a half? You got to have both. Okay. And the beauty of the Roth, as we've discussed, is the diversification that it can provide in retirement. We talked earlier, don't lose hope if everything you've got isn't a pre-tax bucket. We're kind of talking mostly about traditional IRAs versus Roth IRAs. A lot of times a traditional IRA is funded through a 401k rollover, right? So there can be huge balances there that are pre-tax. And I have a lot still in pre-tax. I was contributing before the Roth IRA was around. So, I'm still going to have a lot there. But don't lose hope. This Roth IRA is just another feather in your cap to help diversify what you have in retirement. So it gives you choices. When you're pulling down money or you're drawing down, you get to the point where you're like, okay, I finally worked hard, I've saved hard, I've done well. How do I pull down or draw down my assets to minimize the effect of taxes? That's what the Roth is good for. So don't lose hope. If you're like, oh, I'm listening to her and I should have done a Roth IRA 20 years ago, don't do that. But just know that it's another feather in your cap that you can use now to start getting, some diversity and some choices when you're in maybe a higher tax year. Maybe you'll be able to draw some on a Roth basis to avoid bumping up into the next tax bracket, for example.
Yeah. And let me just jump
Exactly.
in here because I think the listeners really have to understand, because Heather, I've heard for years and years and years, 59 and a half, right? And I'm cresting there. I'm getting so close. Nobody has ever told me about the 5-year thing. So I'm sitting here going, oh, well, I got to go back and do my math. And
Well,
that's
but be careful though. So the 59 and a half thing means a lot of things. So 5-year thing only applies to the Roth IRA, right? So 59 and a half, if I'm have a traditional IRA and I want to take it out now, I'm 53 right now. If I want to take it out, unless I have some exception, I'm going to pay taxes on that traditional IRA distribution, and Uncle Sam's going to go pay up for another 10% because you're 53, not 59 and a half yet. And you don't look dead to me. Thank you, Lord. You're not disabled. No, you're not disabled. You don't have a first-time home purchase. You aren't paying for qualified higher education expenses or education expenses. You don't have medical expenses over 7.5% of your adjusted gross income. There's all these different rules that apply for just other things, for just traditional IRAs. But for purposes of the Roth, you got to have it for 5 years and you got to meet, usually it's the 59 and a half we're trying to get to.
Yeah.
So those are the two things. Yeah.
Well, and and that's why, I keep referring to you as a retirement tax expert, because you understand all of these little things. It's like going to a CPA, right? Who understands the tax code that I don't understand. And that's how he can help me save money and things. You and Johnny and his team help people plan a retirement properly, understanding this entire landscape to say, okay, based on your situation with your income, your age, your family, here are the moves we need to make so that you'll have more net income in retirement.
That's right.
Right?
Yeah, that's right. And, it's also good because, people tend to, where they're going to go for advice when they're planning for retirement. They're either going to go to their CPA or to their financial advisor. Those are the two most powerful people in the arsenal, right?
Yeah.
And so I think sometimes even working together with those people, because there are some things that CPAs aren't as specialized in. I mean, I know for my own, he's not going to listen to this, but I remember, last year, I still use a CPA for my business. And so I did in my taxes. And so I had him do this, and I had to kind of school him a little bit on
Yeah.
a wonky Roth conversion that went bad because they withheld taxes. I did a backdoor Roth thing. So it wasn't deductible, yet they withheld taxes. It's a whole nother story, but I had to sort of help him along the way on how to report that because the
Yeah.
custodian screwed up. The point is, it works to have a group together that can look at all of the different things, because CPAs can specialize in certain areas, but might not be as proficient in the areas that Johnny is, in
Right.
terms of what to look for in retirement and understanding the retirement rules that go with it. So sometimes it pays to talk to both,
Oh,
right?
it totally does. It
And
totally
the people need to understand when you're talking about a Roth, it's not just, hey, I'm 40 years old. I'll throw money in a Roth for a few years and take it out when I'm 48 and have all this tax-free money.
Right.
It's a Roth IRA. It's still an individual retirement
Right.
account. So once again, think long-term,
Right.
59 and a half. That's the way you got to think about these
And
things. This is
that's the whole point. If you can, technically, using your example, Johnny, someone could contribute to a Roth for, say 8 years, put their $7,000 in, and then they say, well, I want to take money out at 48. Technically, they could do that, right? They can take because it's the contributions come out first, but it defeats the whole purpose. The whole
Right.
purpose is to put as much into the Roth and not touch it, because you're wanting that to build up so that it grows tax deferred. All that basis sits there, and it grows tax deferred, so that eventually it becomes this nest egg that is all tax free. So the whole point of a Roth is you want to sit, hold it, let it grow, grow, grow. And then it becomes tax free when you meet that 5 years and you're 59 and a half. So you really need to work with someone that can help you conceptualize, okay, how do I do this to maximize the growth in the Roth? What's the best person to do it? If I need income immediately, is this the best choice? Because you don't want to put in a Roth if you're going to turn around and say, well, I'm going to take it back out. That's not that can get you into trouble too, in some cases, especially if it's a conversion. So you got to make sure you're working with people that understand what your needs are, what your long-term goals are, how long you plan to hold it, and all of those things to make sure you don't get into a pickle.
Yeah, you don't want to lose the benefits of the whole
Exactly.
purpose of the program. And the other thing, Heather, we kind of touched on this a little bit, but so I got a 401k. I'm 61 years old. I'm maxing out. I'm doing the extra amount of money. What is that?
Okay.
20 some odd thousand
Yep.
dollars plus a
Yep.
little extra. I can do that at my work. Can I still do a Roth on the side?
Yes. So
Yes, you can, right?
your contribution to you can max out a 401k. It has no bearing whatsoever on the Roth IRA side. You just
Exactly.
have to meet the AGI limits. There are limits to how much you can make based upon your tax filing status. So that's all you have to look at on the Roth side. So you would have to look at what the limits are for your tax filing status. Now, on the traditional IRA side, which we really didn't talk about, and that's where people get confused, if you're an active participant in a qualified plan like a 401k, or even if you're in, let's say, a profit sharing plan or a SEP, where you're not putting any of your own money in, but your employer is, that's still considered active participation. That's where it depends on whether you can deduct your IRA contribution, because then the AGI, the adjusted gross income phase out limits by your tax filing status, goes lower. So that's where participation in an employer sponsored retirement account can affect deductibility of a traditional IRA contribution, but has no bearing at all on whether you can contribute to a Roth. That is strictly based on your tax filing status and what your adjusted gross income is. I'm glad you brought that up, because that confuses people.
Yeah,
It just
we hear
confused
that a
me.
lot. Yeah, so
Yeah.
basically the bottom line is if I have a 401k, I'm contributing to it. I can still open up personal Roth on the side if I want to, just following those AGI
As long
guidelines.
as I'm under,
We
as long as you're
we
under
could
the AGI.
we
Now,
could figure that
yeah.
out for
And
sure.
here's the other thing. There's also what's called designated Roth accounts. They're equivalent to a Roth IRA, except they're in 401k. So I say,
Exactly.
this is the thing. It's been going on for years. More employers are offering them. That means that instead of deferring my own part of my elective deferrals on a pre-tax basis into my 401k, my TSP, my 403b, whatever the case may be, I can now put it in on a Roth basis. Well, what does that mean? I'm not going to get a reduction to my current income because of it, because I'm putting it on a Roth basis. But guess what happens? Well, eventually I'm hoping that I'm going to get tax-free distributions later. So I say if you can do designated Roth account contributions or elective deferrals, you might consider doing that too, because oftentimes you can get a lot more into the 401k Roth, than $7,000. So you can look into that as well as an additional way to bump up the Roth side of your contributions.
Which
Yeah.
is a
So that,
huge thing we're running into more and more. So many clients are coming in. Check with your 401ks or your employee plans, because more and more are offering that exact thing out there.
Absolutely.
And that
Absolutely.
is something huge to take advantage of. We recommend it all the time, and people don't realize it. Oh, I have that in my plan. I have that in my plan. Man, take advantage of that kind of thing, because it is just such a bonus to be able to have. And more and more places are doing it. So your place might have that availability, and we can help you find out if it does, for sure.
Yeah.
well, and the other thing where you really can help people out, Johnny, and you're down in Florida enjoying a condo and a vacation because of something your grandparents started putting together years ago. When we think about legacy, one of my sons is 25. He moved into Kentucky and he got a job. He's a physical therapist, and he's like, "Okay, Dad, I've got to make my designations for retirement. What should I do?" And I'm like, "You're asking me?" And so even not, I mean, you may be heading towards retirement, but you may have children who are in their workforce now who are pretty clueless about all of these options that Heather just rattled off, and Johnny understands. That's a great time to connect them with Johnny and say, let me help you understand what you're doing today. Just like Heather's younger sister, who's young, but she's going to have years of growth, tax-free income coming out. That's where Johnny and his team really come to bat. So I just want our audience to understand, yes, this is for you, but it's also for your adult children to help them get further down the road than you and I probably ever will be, because we're setting them out on the pathway at a young age. And that's where Johnny's his expertise and his team, like Heather and others, can really, really help you put your retirement in place so that, yeah, you can retire at new heights, right? A lot of this is covered in Johnny's book. A lot of this isn't. Heather is a gold mine of information, and she is just scratching the surface, folks. And so this is episode 3 of this mini series. I can't wait for the next one. And if you've missed anything, go back and re-listen to this, and then reach out to Johnny and have the conversation, because there's so much money on the table. And at the end of the day, it's either going to go to Uncle Sam or it's going to come to you. We want more of it coming to you, so you can retire at new heights and have the retirement you've always dreamed of. So Heather, Johnny, thanks for this episode. I can't wait for the next one. It's been phenomenal.
Thank
Thanks,
you.
Mike. We'll see you soon.